You're listening to a Mint podcast brought to you by HT Smartcast.
Hi, I'm Satya Sontanam from Mint's personal finance team. Welcome to Why Not Mint Money. For this episode, our guest is Saurabh Mukherjea, founder of Marcellus PMS, who is going to share how he goes about investing his personal money. He believes that equity is the only asset class that sees significant compounding over the long term. Known for his coffee can style of investing, Saurabh allocates 90% of his personal investment portfolio to equities and just 10% to debt instruments, that too in fixed deposits for emergencies. He's also a NPS, National Pension Scheme enthusiast due to the tax benefits and low fee structure that the product comes with. I catch up with Saurabh to ask him about how he manages his personal finances. A small caveat before we get into the conversation. Personal finance is very personal. Each investor has their own preference and risk appetite. Do your own research before investing. The information shared in this podcast is only for educational purposes. Now, without any further ado, let's invite Saurabh Mukherjea.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Saurabh, how are you?
I'm fine, thank you, Satya.
Sure. Saurabh, last time when we spoke to you about your personal finance journey, you told that you invest about 90% in equity and about 10% in debt. And you also said that you are not a very big fan of debt products. Just want to understand how it changed in the last couple of years, and how do you look at equity at this juncture?
No, look, Satya, it's been the same. It's been the same throughout most of my working life, especially after my wife and I became parents around 15 years ago. We keep that 10% in debt. Basically, these are fixed deposits. That's our kind of rainy day corpus. That's our safe harbor in case something goes really badly wrong in our lives and we need a lump of cash quickly. I've really never thought of debt as a kind of investment avenue. We use debt as a kind of rainy day fund, and the only investment, only asset that I think really compounds for people like us is equity. In India, neither gold nor real estate really are long-term compounders. So equity is 90% and debt is 10%. It's been like that for the last 10-15 years.
Could you also talk about other investment classes like, what's your view on real estate, gold, and maybe unlisted equity as well?
So look, we own the house we live in, Satya. We own the house we live in. But beyond that, I honestly don't think I can make a rational case for owning residential real estate in India, right? Rental yields in cities like Mumbai, Delhi, Bangalore, rental yields are 2-3%. The cost of a home loan is 7.5%. And therefore, it makes no mathematical sense unless there is some rampant appreciation in real estate prices. It makes no rational sense to own residential real estate as an asset class. We own the flat we live in, but that's about it. Even commercial real estate, you're getting rental yields of say 6-7%, and cost of borrowing is 7.5-8. So even commercial real estate is a better asset class than residential real estate. But again, it comes with illiquidity. And certainly in Mumbai, for prime commercial real estate, the ticket sizes are so big that it's really beyond my wife and myself, and therefore we stick to equities 90%.
Could you walk us through sorry to interrupt you.
What?
Could you walk us through your home buying journey?
Sure. So we migrated to India in 2008. We had a bit of money when we came. Basically, I'd sold my company in the UK when we migrated here. Our son was 6 months old then. This was 2008. But when we got to India in 2008, middle of 2008, prices looked very high to us, right? Again, I did the same maths. You compare the rental yield to the cost of borrowing. And the rental yield, at that time, the cost of borrowing, Satya, was, I think, 10%, closer to 10%. And the rental yield was, some pathetic 2%. So I said, this is crazy, makes no sense. Luckily for us, Satya, the Lehman Brothers happened. So luckily for us, Lehman Brothers happened, which is why I had actually sold the company in the UK in the first place. But thankfully, Lehman Brothers resulted in residential real estate prices halving in the suburb of Bombay where we were renting at that point. So 2009 September we bought, exactly a year after Lehman Brothers we bought, and that's been our main real estate investment ever since. So by that time we were also parents of a daughter. So son was born in the UK, daughter was born in the suburb of Bombay, and we bought basically a house for the family. We were lucky that we got in after the Lehman crash, because since then prices went up for 3-4 years a little bit. But last 10 years, the price of the flat we live in Bombay has appreciated by 0%. 0% appreciation. Thankfully, the mortgage was paid off a long time ago. And I think one of the things I keep suggesting to people is if you do have a mortgage, pay it down as aggressively as you can. A lot of people believe that having a mortgage as a tax shield is a clever idea. I don't think the maths on that is particularly compelling. So we paid down the mortgage over 5-6 years. And so we own that bit of real estate, but that's our only real estate investment.
So you preferred repaying mortgage loan versus investments at that point in time? Can we say that?
That's right. That's a good point. Yeah. So whilst we had the mortgage, those 5 years, the priority was to pay down the mortgage, because remember, I'm talking about an era where cost of home loans was 7, 8, 9, 10%, closer to 9, 10%. And therefore, if you think about it, right, had we invested in the Nifty, we would have earned 13%. But the cost of mortgage, if you knock off from that capital gains tax, the cost of the mortgage wasn't too different from the Nifty return. So our point was, let's pay the mortgage down, and then once we paid the mortgage down, our cash flows got freed up, and that's actually when my journey as a coffee can investor using Rob Kirby's principles started, somewhere around 2013-14. When we had enough cash to invest.
Understand. There's always a debate about buying a house versus renting a house. How is it for you? I mean, you always wanted to buy a house, or is it because of the family, friends that you actually, bought a house?
I think that's a very, very sensitive question. No, so look, for the first 13, 14 years for the first 10 years of marriage, we didn't buy. And we were sort of, just husband, wife. We lived in a tiny flat. In the UK, we lived in a tiny rented flat. Shortly after our son was born, we migrated to India. But once we migrated to India, once our son was born, and once we knew our daughter was on the way, we realized that with the family on the way, the years of kind of living in tiny flats and changing flats every 2-3 years when the landlord gave us notice, we realized that wasn't gonna be viable anymore, right? And that's when the decision to buy really took place. So we ended up, the only first time we bought was in India. In the UK, we never bought a flat. In fact, in the UK, we never bought a flat again, because I'd done the maths in the UK that the UK housing market was overvalued. It crashed, much like India. The UK housing market crashed during Lehman. But the reason for buying was not so much a desire to, avoid rents or have a property, but it was more that once you have little kids, you can't shift every 2-3 years. And most landlords tend to give notice every 2-3 years. And to avoid that, we ended up buying in Powai, the suburb of Bombay where we live in.
Sure. If we also ask, what did you do to do the down payment? So there must be some heavy down payment that you must have incurred. Sure. So you booked profits up. You said it's during this 2008-9 time.
Yeah. So I sold my company in the UK in May 2008, anticipating Lehman, right? So Jan 07 is when we figured out that there's trouble coming. So through 2007, we got our clients out of their investments in British equities. I was at the time living in the UK. Then we sold the company in the early months of 08. 11th May 2008 is when I got paid for selling that company. We moved to India the very next day, actually. And then we rented for the first year and a half. And then when the time came to buy, we made the down payment using the proceeds of my the proceeds of selling the company in the UK, and then we borrowed a little bit from a prominent Indian home loan provider.
Understand. I think in your whole career journey, there was you're part of a business, and then maybe you also worked as a salaried individual, and also again into a proprietary firm. How did the personal finance journey evolve all these years?
So I think initial part of my life, for a few years, I worked for Accenture, the giant tech and consulting firm. So when I was in Accenture, I didn't know much about finance. They had a corporate pension plan, which I joined, and I still am part of that corporate pension plan with Accenture. It's actually a pretty good plan managed by a British index fund provider now. So the first 3-4 years was just joining the corporate pension plan. As it is, when you're 22, 23, you're not earning a great deal of money. But we had some savings, and we used to invest in the corporate pension plan. As it happened, the corporate pension plan itself was an index fund. Effectively, it was an index fund. So when we had a little bit more money, we also decided to become indexers. So it's interesting, even though at Marcellus, we manage money for the best part of 10,000 Indian families. Even though we manage money for the best part of 10,000 Indian families, my first 3-4 years of investing my wife's money and my money was in an index fund.
This was in what year?
This is 2000, 2001, 2002, 2003. Sure. Right. So 2004, I became an equity analyst in the UK. And when I started this company, Clear Capital, the company that I went on to sell, 2004, I became an equity analyst there in a company which I had co-founded. So I put myself through the CFA program, taught myself equity analysis. And that's when I started active investing in the UK. I set up a pension pot for myself with St. James's Place Capital. And within that pension pot, so the reason you do that is in that pension pot, you can then buy, you can make investments in a tax-advantaged pot. And that's when we started doing active investing with our savings. So 2004, 5, 6, 7 active investing with our savings. 2008, we sold Clear Capital, migrated to India. 2009, we used the proceeds from selling Clear Capital to buy the flat in suburban Bombay. By 2014, the mortgage got paid off, and 2015 we again started doing active investing, but this time in India with the Rob Kirby coffee can investing style being a big influence, and it stayed like that. Once Marcellus got created, Marcellus's portfolios basically became our equity savings portfolios.
Understand. When you started Marcellus, I'm sure that you would have actually taken a lot of your portfolio in other assets to invest in Marcellus. How did it feel like? I mean, because it's like most of your wealth taking out from somewhere and then investing in Marcellus. And did you think about diversification? I know you believe in your fund, but.
So you're right. So we did a lot of thinking, but here was the maths behind it. So the first thing my wife and I decided, this is around 5 years ago when we made these decisions, actually, when Marcellus was being incorporated, we said, let's keep a rainy day pot. That's the 10% debt. So that was when that became really entrenched in our heads, that we have to have 10% in debt as a rainy day pot. Then the second thing was that leaving aside whatever money we put inside Marcellus's balance sheet to incorporate the business, which was the best part of $1 million actually. But leaving that aside, we said the equity pot should be at least big enough to see our kids through university. And that's something that's still foremost in our minds. Our children are in their mid-teens, so we will be incurring their university bills over the next 5-6 years. And therefore, the equity pot, we look at it very carefully, because that equity pot will effectively finance our children's education. That equity pot is managed by Marcellus, but it was structured in exactly that way, that we said everything barring the rainy day 10% in debt, and everything barring the children's university education corpus, we pumped into the Marcellus balance sheet to incorporate the business.
Sure. You are an active fund manager, but I'm asking this question. For someone who doesn't have much knowledge about investing, do you think index and passive investing is the best way to go about it? Even Warren Buffett is asked this question, and he said for his wife, he suggests passive investing in index funds, some Vanguard fund. So what do you say about it?
So look, in coffee can investing, we've said as much. In coffee can investing, the book that we published in 2018, my colleagues and I have said as much that if you don't have a great deal of money to find an active fund manager and you don't have the expertise to find a good active fund manager, say you have 30-40 lakhs, it's certainly worth doing passive investing. Look for a low-cost passive fund from a reliable house and start doing that as early as possible in your career, right? The earlier you do it, the better it is. It's only for people who I think have, say, 50 lakhs, at least 50 lakhs, more likely a crore plus, that choosing a PMS, choosing an active fund manager becomes a relevant consideration. But for pretty much, I would say 90% of people who are reading your article, I think index investing makes a lot of sense.
Sure. How do you go about retirement saving, Saurabh?
So the maths we have done suggests that if my wife and I want to have, say, a retirement lifestyle from age 60 to age 85, say we want a retirement lifestyle of roughly 50 lakhs a year of spending post-tax, then the math that we've done, so DCF maths we've done, suggests that we'll need to have a retirement corpus of at least 20 crores. So once the kids are done with the university education in the next 6 years, that will then be the next target to get there. At the moment, the focus is on making sure that the equity pot is big enough to finance the kids' university education. After that comes the creation of that retirement pot of at least 20 crores, so that from age 60 to 85, you can have a reasonable life on 50 lakhs a year post-tax.
Sure. You plan to retire in India or you plan to go outside?
The plan would be to stay here. We enjoy living here. We believe it's a privilege to live and work in this country. We'd love to retire here.
And we actually didn't talk about the other asset classes. Could you also give your opinion on other asset classes like gold and unlisted equity?
So look, gold, a lot of people I keep meeting people in India who are gold bugs. They have this real fascination for gold. In their mind, gold is compounding at some great rate. But the data doesn't show that, right? If you see the data on gold as an asset class over long periods of time, it gives you around 8%, which is meaningfully less than, say, the Nifty long-term return. And gold's volatility is similar to equities. And gold is positively correlated to equities. So gold is neither giving you diversification, nor is it giving you better returns, nor is it giving you lower volatility. So I don't quite see the fascination with gold. A lot of people say gold is a safe harbor asset. There is very little proof of that. There are plenty of financial crises, financial downturns where gold corrects in line with equities. So we've therefore steered clear of gold. I explained why resi real estate makes no sense given how weak the rental yields in our country are. That's it really. The equity 90%. Within that equity piece, a fifth of our equity portfolio is international. These are the monies that I left behind when we moved to India. These are the pension pots from the years in the UK. We left that behind, and that continues to compound at a decent rate. In fact, over the last 12 months, it's interesting. In the 12 months to March 23, whilst our Marcellus investments were down 10%, our international investments were up 10%. And specifically, if I look at Marcellus Global Compounders portfolio, it's up around 12% in the last 6-7 months. So as I get older, the merit of having say a fifth to a third of our wealth in international equities becomes much more apparent because there's a natural diversification. Typically what happens is when the Fed hikes rates, the rupee depreciates, right? The sorts of investments Marcellus makes tends to do poorly when at a time of rising rates, because when the Fed is raising rates and the rupee is depreciating, foreign investors tend to be absent from the Indian market, and the sorts of stocks Marcellus has tend to do poorly. But in exactly that circumstance, the international portfolio does well, because when the rupee is depreciating in rupee terms, the international portfolio does well. So unwittingly, I won't claim this was massively done through deliberate design, but it's actually worked out nicely. Having a fifth to a third of our portfolio in overseas equities gives us a nice hedge that in the years, in say 1 out of 5 years when Marcellus has a rough year, when the Marcellus portfolio has a rough year, the overseas portfolio rises 10-15% and buffers our overall compounding in that year.
Could you give a geographical breakup of your international exposure to equity?
It's almost entirely American and European stocks, right? There's very little Far Eastern or Asian in it. The international portfolio is almost entirely American and Eastern stocks. So these are stocks like, and I stress again, these are the sorts of stocks that Marcellus' global compounders invest in. These are stocks like Microsoft, Amazon, Costco, Nvidia, and so on, right? So these are large global compounding machines, similar to the sorts of investments Marcellus makes in India, HDFC Bank, Asian Paints, Titan, Pidilite, so on and so forth. By the way, my parents who live in the UK, my parents live in the UK, a fifth of their monies are invested in Marcellus' portfolios in India. So my parents are 80% UK, 20% India. We live in India, our portfolios are 80% India, 20% America and Europe.
Sure. Within the domestic equity exposure within the Marcellus, is there any breakup that you want to share about how much you're invested in different schemes?
Yeah. So within our Indian investments with Marcellus, by the way, all our Indian equity portfolios are with Marcellus, with one exception. I'm an NPS investor. I think the National Pension Scheme is a very good investment construct. So all Marcellus employees are encouraged to join the NPS. And I am a very enthusiastic participant in the NPS. I think it's index investing inside a retirement pot. And I allocate money to NPS every month. But if I look at our Indian equity pot, it's basically 60% large caps, around 20% mid cap and 20% small cap. Right, and that gives us stability, that gives us compounding. If I look at the last 6 years of following this construct where Marcellus manages my equity portfolio and the global portfolio is outside the country, if I look at my 6-year compounding with this construct, we would have compounded net of fees at around the 18% mark, which is significantly ahead of the index and a good outcome for my wife and myself. And remember, This money is going to be used to finance the children's university education.
Understand. You talked about NPS, that you're an NPS enthusiast. Could you elaborate on that point? Because still a lot of awareness is required on NPS investment, which is a very good product. So could you elaborate why you really like that product?
Yeah, so I think, look, there's 3 aspects to it, right? Firstly, the employer contribution is, on the employer contribution, I get tax relief. Right, so basically, part of my salary, my employer is paying into the NPS, and I get tax relief on that. Secondly, the fees are low. In fact, even if I did an index fund, I would not be able to get this lower fee structure. Right. Thirdly, excluding fees, there are no other operating expenses worth talking about. Right, the fund manager is not advertising, nor are they charging, nor are they doing active trading, and so on. Right, so the fees are low. My employer's contribution is tax-free. And finally, perhaps most importantly, right, you asked about retirement savings. The fact that till age 70, I can't touch this money, right? That's the way the NPS is set up. I can't pull this money out. I think that's, in a bizarre way, it's a good thing, right? Because this pot of money will keep compounding for my wife and myself for the next 25 years. And hopefully that means at age 70, when we draw it down, it'll actually finance the last 10-15 years of our lives.
Sure. Could you give us a breakup? Not breakup, but what's the exposure to the NPS in the domestic?
Out of our equity corpus in India, so equity, remember, is 90% of our portfolio. Out of that 90%, 1/5 is abroad. Domestic is 4/5. So out of that 90%, effectively 80% of our total wealth is in Indian equities. Out of that, Satya, 1/4 is NPS, 3/4 is Marcellus. Out of the equity portion in India, 1/4 is MPS, 3/4 is Marcellus.
Sure. And you own the unlisted equity? Have you ever tried investing in?
No, it's just, I own Marcellus shares. Right? That's enough unlisted equity in my life.
Okay. So it's like ESOP here. I mean, owning the shares. Marcellus.
Yeah, you could say that. I mean, in my case, it's actual shares rather than ESOPs, but I have some ESOPs in Marcellus as well. In fact, it's an interesting point you make. This year, the current year, I've actually given up some of my salary to get more ESOPs in the firm. I wanted a bigger stake in the firm, and this year, the current year, I've given up some of my salary to get ESOPs in the firm. But the bulk of my Marcellus shares are outright shares as opposed to ESOPs.
Sure. So whatever portfolio allocation that you just shared is excluding the Marcellus investment or share in the Marcellus.
Yeah.
Understand.
Yeah, the reason I'm excluding that because that's unlisted. There is a market within which we buy and sell from each other, and there's a couple of external shareholders who also buy shares from us from time to time. But it's unlisted, and I think the valuation of that is so big it'll probably end up. If we discuss that'll end up overshadowing the rest of the actual equity portfolio. But when my wife and I do our discussions around our retirement planning or our children's university education, we don't really count the Marcellus shares because I don't think we plan to sell the Marcellus shares for several decades. We are hoping that the firm will continue going and the Marcellus shares will continue accreting in value for several decades to come. So we don't really count those shares in our wealth planning.
Sure. And this is a general question we ask in Guru Portfolio, but I think in your case, I think readers will also be very interested on this question on the performance of your entire portfolio in the last 1 year.
Sure. So the Marcellus bit, right, as is I think well known, the Marcellus bit of the portfolio was down 10% in the 12 months ending March 23. Right. Since then, in April, May, it's up 12%. But that in the 12 months ending March 23, the tax year ending March 23, the Marcellus piece was down 10%. The international piece was up 10%. And again, mirroring the global compounders, Marcellus global compounders portfolio is also up. In fact, it's up 15% in the last 6 months. The global compounders piece. But in the year to March 23, the Marcellus portfolio was a drag on our overall wealth. If I take a 6-year picture, over the 6 years, net of fees, the Marcellus investments we've made has given us around 18% returns. And over those 6 years, our international investments have made us around 10% per annum.
This is as on March 2023.
March 23.
March 2023. Yeah.
Okay. This is as of March 2023.
Yeah. So because you are
interesting, right? I am as interested as anybody else in Marcellus's performance because my entire life savings are in it.
Yeah.
So the fact that April, May, the portfolio, Marcellus's portfolio have given around 12% as on April, May. That makes my wife and me very happy. We're able to think about our children's future a little bit more securely. And I think that's important, right? This is part and parcel of equity investing. If you want to do the best for your family, I think you have to take a degree of risk. Our downside protection is that pot of debt, which is our safe harbor protection. The equity piece naturally will zigzag about. And if we get too worked up about it, that the year to March 23, we were down 10%. Let's now reduce our equity exposure. That's exactly the wrong thing to do, right? Yeah. Imagine had I redeemed on 1st April 2023, we wouldn't have benefited from the 12% rally in that same portfolio's performance in April, May 2023, right? So for 12 months we went down.
Yeah.
12 months to 23 went down, and then in April, May we more than made up. We more than made up for that fall.
Okay. If you have to say overall portfolio return, how much would it be?
Overall portfolio return is down 2%. So our overall portfolio, domestic plus global, was down 2%. Basically, we were down on the global domestic piece, up on the global piece, up in NPS. Our NPS did well. Our global piece did well. Our Marcellus shares were down 2%, and overall we were down 2% for the year.
Okay. And you said your wife and you are investing together, and you must be very clear about how this equity investing works, and even when it is down, you don't seem to perturb much.
Yeah.
How about your wife? How do the discussions with your wife happen at home? Do you discuss your financial decisions with her? You guys talk a lot about finances.
Main financial decision, in a way, think about her. She's the client, so to speak, and I'm the fund manager. So she says, how much will it cost to send the kids to study abroad? So we'll do the math on how much will it cost. Then she asks me, will we have enough money to finance this? And I have to sit down. We do the maths together on will we have the relevant corpus to finance our children's overseas education. She doesn't question me on, why did you sell Relaxo? That seems to be the question half the country wants to ask me. Neither do my parents. My parents are also clients of ours. They don't question me, why did you why did you sell Relaxo? But naturally, they're all human beings. My wife, my parents are human beings. When you tell them that we're down 10%, they tend to worry a little bit. And then you tell them we are up 12%, they tend to feel a little happy. But none of us are particularly, fidgety people. Yeah. So once a year we have these discussions. My parents and I about their finances, and my wife and myself about our finances. Once a year have the discussion, and we try not to think too much about the here and the now, about how rich are we or how poor have we become. It's more around what are we trying to achieve over the next 5-10 years, and are we in a position to finance those goals. Yeah. We live fairly frugal lives. It's not as if our day-to-day lifestyle is incredibly cash consumptive, and therefore the ongoing thinking about money, ironically, is minimal beyond this once a year personal finance discussion.
Sure, understand. You have 2 kids. What is something that you want to teach your kids about finance, or already teaching them about finances?
So the interesting thing is, they read some of the books that I've written. They read some of the books. So
they understand.
They understand some of it. My son is 15, so he understands a little bit more. My daughter's 13, she understands a little less. But the interesting thing is, my daughter's become a bit of a mini businesswoman herself. So she bakes cakes and cookies for her friends, and she sells them at school. So she's figured out, how to generate free cash flow. So every weekend we discuss how much free cash flow she's generated and how she can use that to grow her baking business further. So it's interesting. My daughter's coming at investing from the perspective of an entrepreneur. Sure. My son is coming at investing from the perspective of an analyst who reads books and tries to understand investing. So my son's read a couple of Peter Lynch books. He's read Coffee Can Investing. I'm hoping he continues with the habit. My daughter hasn't got to that stage yet, but as I said, she's already a mini entrepreneur, and we've had several discussions on free cash flow and capex between father and daughter.
Sure. Lastly, are there any investments in art, anything as such as unconventional asset classes?
We have a few paintings at home, a few original paintings at home that we have bought. But we didn't think of them as investment. They just look nice, and we bought those paintings. I don't know. I don't think they're worth a great deal, but they look pretty at home, and they make the house feel nice and warm.
Sure. Maybe just last one question, Saurabh. What is that something that you've realized in the last 1 year that either in terms of business or personally, what is something that you've been implementing in the last 1 year?
When you're younger, you sort of read these things in books. As you get older, you realize that you watch other people live their lives, you live your own life. I read 20 years ago, Satya, Warren Buffett had said, and I had read that the stock market's main function is to transfer wealth from the impatient to the patient. Right? And in a way, as I get older and I see thousands of our clients, I see that at work. Clients who fidget, investors who fidget, who are very fidgety, short-term oriented, they end up making poor investment decisions. And the calm, patient clients who deal with life with equanimity they just end up benefiting from the impatience of fidgety people. And then once you've absorbed that and understood that, you obviously try to teach yourself as much patience as you can, so that you're on the right side of that equation. But I think it's one of the most simple and most powerful sayings about investment. Stock market's main function is to transfer wealth from the impatient to the patient.
Sure. What do you do for your health? Health is wealth, so.
I have a yoga instructor. He comes at 6 a.m. in the morning, 4 days a week. So 6 to 7, I have a yoga instructor. It's been very helpful. I've been doing yoga with him, learning yoga from him over the last 3 years, and it's had a big impact.
You don't miss it at all?
I don't miss what?
Yoga class.
Yeah, I don't miss the yoga class. Unless I'm ill, I don't miss the yoga class. And then beyond that, 1 or 2 days per week, I go to the gym. So the yoga instructor is my main source of health and fitness, and I'm very glad that he's there because it made a big difference to my life.
Sure. That's all from my side, Saurabh. Thank you so much for joining us today. Thank you.
Thanks, Satya. Thank you very much for doing this. Take care.
Thanks. Bye. That's all for now in this episode, listeners. If you have any queries or suggestions, you can reach out to me on Twitter. My handle is @Satya Sontanam, SatyaSontanam. Or you can also write to us at mintmoney@livemint.com. Bye-bye.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.